welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, ever since the capital gains tax has been reintroduced on equities, investors often hesitate to make even the necessary changes in their portfolios. But is it always beneficial to deter those changes because of capital gains tax? Are you wondering if there's a way to reduce its impact? If you want answers to any of these questions, watch today's episode.
Most investors will be tempted to avoid the capital gains tax because that is what we have been used to. Till January 2018, all the gains from equity funds and equity shares was completely exempt. So if you had any profit, long-term gains, and long-term is from the tax point of view is defined as holding for more than 1 year. So if you bought a mutual fund, equity mutual fund, or a hybrid mutual fund which had more than 65% into equity, your 100 rupee became 120 and you held it for more than 365 days, your 20 rupee gain is completely tax free. So in India, there was a situation that, two kind of earnings were tax free. One was farm income from farming and the other was, the returns from equity. Now it has become taxable. It has become taxable effective 1st of February 2018. The government has also provided for all your investment that you made long time ago, 5 years back, 10 years back, 15 years back. All the gains that you have accumulated till 31st of January 2018, that is tax exempt. So your 20-year-old investment, a good part of the gains will be tax exempt. The price that was there on 31st of January to now, whatever is the gain, that is liable for capital gains tax. Whatever is the gain from that point of time, you will be liable for 10% capital gains tax. So you have to see that what is that amount of gain, and you can set up your portfolio at Value Research Online. And Value Research Online portfolio, this gives you a very interesting breakup that if you made an investment 15 years back, what part of that money is tax exempt, what part of that money is taxable, because you need to consider the price as on 31st of January 2018 to arrive at the gains so far. Look at these gains and see that whether you should be paying 10%, because your gains get reduced by 10% the moment you do this transaction. If it is a large amount of money, you might consider it. If it is not a large amount of money, then let it be. And if you have some visibility in terms that you need this, you just might redeem this money for your consumption or spending in a year or two, then maybe avoid it. Then the other reason is that you have invested in a fund which has turned out to be not so good and you would like to move this money. This is the time when you should not think anything. One should be guided by the merit of the investment decision. You should be making good investment, and once you have spotted that your investment is not good enough, then you should move your money. There's an old saying that death and taxes are unavoidable, so you can't avoid it, and don't be tempted to avoid it because there is no tax deduction at source. Many investors might think that what if you don't pay or what if you don't declare. Don't do that because there is a great disadvantage. One is that if your gains are 2 lakh rupees and more, Government of India has access to all the information. The tax information network that we have, they will have access to the money that you invested, the money that you realized, and the gains. So they are very much within they have the capability of sending you a tax bill, and you just might get an extra tax bill if you don't declare it. That is one. The other is that one should be very, very prepared for paying the capital gains tax because it's a nice tax. You pay on capital gains, which means that you have gains in the first place. If you invested 10 rupee and it has become 20 rupees, so you are going to pay gains on the capital gains tax on the gains. The other most important reason why you should be paying the capital gains tax is that it actually keeps your money legitimate. So don't be tempted to avoid the capital gains tax. Now, you don't have too many tricks to avoid capital gains tax, but you can little bit. There's an exemption of, capital gains up to 1 lakh rupees is exempt for small investors, which means that you can, if your annual tax bill is going to be 10,000 rupees, you don't have to pay up to that much. You don't have to pay, and there is a possibility that you will invest some money and you will keep investing it for 5-10 years, and whatever is the gain after 5-10 years, you will be liable to pay taxes on that. But meanwhile, every year entitlement of 10,000 rupees on a gain of 1 lakh rupees, you are missing out. So can you avail this? Yes, you can. If you are sitting on some gains with your existing investment, which you intend to carry on, so sell it and buy it again. As a result of which, your cost of acquisition will come down. You would have booked a gain and you will be liable to pay taxes. And if your capital gains tax is going to be 10,000 rupees or less, or if you have a 1 lakh rupee gain, it will be tax exempt. So this is the only trick that you can play. You will, basically this is not tax avoidance. This is tax planning. If you find it complex, then might as well avoid it. Because there is a possibility that the initial years of your investment, you may not be sitting on meaningful gains. The gains from equity comes in a fairly, unpredictable manner. Few years you don't have gains and suddenly you will have substantial gains. So tough to predict that. But here also Value Research Online Portfolio Tracker will help you do that. It will be giving you a status of your gains that you are sitting on. So if you have to do any such planning in the month of March, so that you can sell your investment and then buy it and invest again, check there that which all investment are, where you are sitting on gains. How can you do some methodical planning that can help you do that? The way to make these changes is that, every now and then we feel that, we need to make some tweak in our portfolio, a fund that we invested and now we don't like it. So maybe combine it with some of the changes that you want to make in your portfolio. And the other is that if you have to just do that, if you have no discomfort with your existing investment, then might as well, sell and buy and invest again. And the best time to do it is, around March. You can, that is a time when we are actually in a frame of mind. Don't try to do it too often, because if you try to do it too often, it'll just generate too much of confusion. And also, you are eligible for all this only if your investments are held for 1 year and more. So good time to do it is the month of March, or when you have to clean up your portfolio or reorganize your portfolio. There are people who are quite methodical with their accounting, and they can do it efficiently. They can keep an eye on it. And if this 10,000 rupees of annual saving is meaningful, then go ahead, do it. And that is the maximum saving that you can do, which is 10,000 rupees of capital gains tax annually. And if you have accumulated sizable amount, and you have to see that if you are sitting on a gain of 20 lakh, 30 lakh, 40 lakh, 50 lakh, which typically happens, if you are investing steadily over a period of time, then in any 10, 15, 20-year period, which I see for most investors, their capital gains is substantial, and their contribution in their own portfolio is very nominal amount. So they might be sitting on substantial gain, and those investors, 10,000 rupees will not make much of a difference. At the same time, you will end up with little bit of paperwork, calculating your taxes and paying the taxes, or at least filing the return. So it depends. See that how relevant is 10,000 rupees for you. If your total income during a year is less than 2.5 lakh rupees, then you are not liable to pay taxes. Income between 2.5 lakh to 5 lakh, which is the smallest and the lowest bracket, there you will be. Besides that, there is a particular 12,500 rupee exemption available on capital gains, but that exemption is not available for equity and equity funds. That is the capital gains exemption of 12,500 rupees available when you book any a gain on fixed assets. If you buy a piece, if you sell a small house or any land, and if you have a gain of that 12,500, the gain component of that is exempt. So that is the exemption which is not available on equity. So yes, if your income is less than 2.5 lakh rupees, you can, by way of capital gains, it can be completely exempt. If all your income is derived by way of capital gains, then you don't have the 80C and 80CD, which is available on health insurance, the Mediclaim, and even 80CCD, which is the NPS, the 50,000 rupee exemption that you get. So those are the investment avenues which are available for tax exemption. You make that investment, and that investment is deducted from your income. That is not available if all your income is by way of capital gains.
Well, with that, it's a wrap. Keep watching this space for more information. And if you like the show, do subscribe to our YouTube channel. Take care. Bye for now.